Well, thank you all for joining me. It's lovely to have you here. So I guess just to kind of kick off this conversation, I don't think anyone here or elsewhere would really question the fact that businesses do need to be thinking about the social impact, the environmental impact that they're having and the implications of these. But I guess the question is, and maybe Nina, perhaps if I could start with you, does this actually create value for businesses? Does it have an impact on their bottom line, or is it purely a regulatory requirement?
Well, I think it absolutely creates value. I think if it is just a regulatory requirement, then all of us have failed in this room. If it's a box-ticking exercise, if it's a compliance-ticking exercise, that's not what this is all about. So effectively, I think if you look at it, there's a multitude of academic studies, practitioner studies, grey literature studies that equate profitability and sustainability, so bring those two together. But if you dive a little bit deeper into it and you look at the kind of value that is created, you look at a better understanding of the organizations that you work with, you look at a better understanding of your suppliers, of your partners, of your consumers. You also look at a fundamentally different understanding of the conditions in which the firm is embedded. Because we know we're living in a world that does not closely resemble the world that we lived in yesterday or a couple of years ago. And organizations that fundamentally understand that adjust their processes, that looks at the risks that we know are coming, are better placed to address these risks, are better placed to take opportunities into account. So if you're investing in an asset right now with a life of 5-10 years, and you're not looking at climate, nature, and social implications of that asset, you're investing in a stranded asset, effectively. So I think there are very fundamental considerations that have to do with value creation on all of those.
Absolutely. And I guess just building on what you've just said, and Kate, maybe if I can come to you, just a similar question, but just flipping it around. What about those businesses that aren't considering ESG? I guess Nina just talked about things like stranded assets. What are the implications for businesses if they're not thinking about these things beyond that?
Well, fortunately, because of regulation, there aren't many organizations that aren't at least ticking a box when it comes to ESG. I mean, the pressure points for organizations that aren't doing this are obviously regulatory risks, but also this could be the other side of it, also could be a value driver. The pressure from investors, that B2B value chain. So you've got investors, you've got consumers, you've got employees, you have buyers, suppliers to tenants. It really depends on the organization that you run. But there's, not being transparent about your different ESG practices, it can lose you money, but it also can, on the flip side, if you're doing it well, you can potentially get a new revenue stream. The other point which you talked about, which is the area that we're experts in, is the physical risk side. If you're not looking at the physical risks of any investments that you're making, then potentially you could be investing in a stranded asset. But also, I read a survey, I think it was yesterday by Capgemini, that leaders in organizations, they say that in the next 10 years, the biggest cause of operational disruption will be climate change in the next decade. This isn't 10, 20, 30 years down the line, but it is now. And C-suite are now thinking, how do we reduce any sort of business disruption, not just direct financial impact, a flood hitting one of our assets, but also heat waves causing work productivity, machine productivity, and how that can financially impact an organization. So there are financial implications if you are not doing this well. But on the flip side, there are also huge opportunities. Those organizations that are going above and beyond that tick box solution and are starting to embed ESG data, physical risk data into that due diligence process, that investment life cycle, they're the ones that are thinking about how they can reprice potential investments. How does a potential high-risk climate investment need to be repriced? Could they get it for a cheaper price versus not just thinking about the stranded assets, but physical risk, ESG data going into the pricing factor as well?
Yeah, absolutely. And just if I could stay with you for one more question. You talked about companies going above and beyond the kind of regulatory requirements. I guess one question would be, what are the barriers to companies from doing that? And why aren't all companies taking that step?
Yeah, sure. So backtrack a little bit. I work in a climate risk intelligence platform. I'm speaking to ESG stakeholders from large organizations across different industries. And one huge common trend is that heads of ESGs, CSOs, they are underfunded and they are under-resourced. I think there are more climate-related open vacancies in the job market than there are climate professionals right now. So there is a huge talent deficit. So organizations that really want to go above and beyond need to be using tools that are available. And, obviously I work in the climate risk side. There are a number of different tools that help scale, automate, make really complex data much more accessible so these organizations can start to embed it into their decision making. So I really believe, this is not the to-do list of an ESG owner or leader is getting much larger, much more complex day to day. So using the ability of external providers, consultants, data tools is absolutely key to help scale them, because this is getting more and more complex.
Yeah, absolutely. And I guess another part of the complexity is that it's not just businesses, right? It's a whole ecosystem, and everyone kind of needs to be part of it. And I guess coming to that point, there are different stakeholders involved. It's businesses, but then there's also other support systems. There's the private, public sector, governments, there's investors, there's consumers themselves who kind of influence it as well. So I guess just trying to think about those alternative perspectives, maybe, Alexander, if I could come to you, and just thinking about it from the government's perspective, what kind of role do you think policymakers have to play in all of this, in kind of enabling businesses to take on board ESG?
And I think that's the key point. It's about enabling. A government's not there to tell businesses what to do or choose winners or losers, but fundamentally it's there to make sure that businesses operate better. And I use this quite a generic word, better, because better means lots of different things, different people. Fundamentally, let's be honest, the government wants companies to be bigger, better, and spend and raise more taxes. That's what they want, but also want to do it in a responsible way. We've got to look at these twin goals. And when you look at ESG at all, we should not just look about sustainability and the governance side strategy. We should look at it as a way of trying to increase the pot. We should try to grow the pot, try to grow business. And the government wants a slice of that pot, obviously, and taxation. So the government wants to help sort of oil the wheels of that. Now, one of the key ways the government can do is make sure that the regulations and also the standards across the board are quite transparent. So everyone can see what it is, businesses know what they're getting into, but also to make sure they're interoperable across market jurisdictions. One of the benefits, you could say, of Brexit was we have more control over what sort of standards that we want. Might be better, might be worse, might be different, but the government can actually choose what sort of standards we do. So maybe tie into some of the other markets across the globe to actually see how our ESG standards can work together. And that is one of the key ways. I think one of the disadvantages government has, government loves to regulate. The government likes doing stuff. The worst sort of government in government's mind is sitting around doing nothing. I've just come from Parliament myself, and we finished about 4:30, 5 o'clock today, which is a disaster for government. We should be going to 7 o'clock. So when there's not enough time for business, we like putting new laws and new regulations. It sort of validates what we do as politicians. So the flip side is, if we keep regulating and over-regulating ESG, all we're going to do is put the economic burden further and further onto businesses, and that's actually going to crush businesses, and actually not increase the size of the pie that we so want.
And just on that point, Alexander, how do you find the balance between regulation and kind of over-regulation? Where does that line
There's
lie?
always going to be that balance, and also I don't think it's possible to say there's too much regulation or too little regulation, especially when it comes to companies. Companies are different sizes. What some large companies can easily deal with, we talked about getting the right climate analysis or paying for various platforms, help it. Smaller, medium-sized businesses, they just can't afford to do that. So regulation has to be adaptable, either different regulations of different types of businesses, or a regulation regime that is flexible, but at the same time, it be measurable against each other. Because ultimately, what the government wants is people to look at 2, 3, 4 more companies and look at some standard metric and say which company is, once again, better, and whatever the better is in the definitions, to make a clear choice for consumer, investors, and businesses.
Absolutely. And talking about investors, maybe if I could come to you next, Eric. What role do you think investors play in all of this? How does that feed into the whole system?
A key role, obviously, and in various levels, actually. Invest Europe is representing, for those of us in the room who doesn't know who we are, private equity, venture capital, and infrastructure fund managers, as well as their investors, from public funds to insurance companies, pension funds, and a number of other institutions that are actually entrusting their money into the fund managers that I represent. And I must say that we've seen for a long while already the impact of ESG growing at our portfolio company level. As investors, we are keen to invest not only to the best in class in terms of ESG, I would say, performance, but also at the companies that we like and that we believe should actually go on this journey. So it's important for us more and more to devote time and resource to analyze and invest in those businesses. Simply said, because our investors want us to do so. And we need to bring to them not only financial performance, but also more and more societal performance. And the two are not actually going in the opposite directions. One is feeding the other. Ultimately, and to echo one of your points earlier, I think that if we don't do the job as investors in the business we own, we'll be asked by the next buyer whether it's actually an IPO for the public markets, or a trade buyer, or another fund manager. What have you done during your tenure for the holding period of 5 years, 6 years, 7 years that you've had? What have you done to change and to move the needle in the right direction on all the relevant KPIs that we would like to see delivered? And when I say KPI, it's not measuring only as a tick the box exercise, obviously, is generating clear value creation that is measurable. And if you don't measure, to come back to the data topic, if you don't measure what you're doing, actually you can't manage it. And that's what we're trying to entice our members to do by offering them the kind of guidance and tools that they need.
Yeah, absolutely. And I know, Kate, you mentioned the data point as well previously. But I guess my question would be, what kinds of data exactly are we looking for? What kinds of data are we trying to collect? How do we measure that impact point that you mentioned, Eric? How do we actually get to the impact that it's having?
We have actually, across Europe, defined a key number of KPIs, a dozen mostly, that we're collecting on a European basis, which means that national associations of venture capital and private equity are also helping their members feed the data, the portfolio companies' data that they collect in our data collection module, so that we can analyze actually the progress that we are making on a regular basis. And I'm happy to say that today we have published our second edition of our ESG KPI report, which measures the progress that we've made on a number of KPIs, whether scope 1, 2, 3 on climate, to number of percentage of female partners at portfolio company at a partnership level. We measure a lot of different data, and we try to see where we're going, basically. And I'm happy to say that the last edition showed that a progress of 60% in terms of declaration. So we have 60% more firms that have engaged into that process, collecting the data, meaning that they have actually pulled it from corporate companies, and they are not only looking at it from an investment perspective, but also from a monitoring perspective, which adds more impact and generates, obviously, better results.
Yeah, absolutely. And that's very interesting. I mean, I guess another point is that, well, it starts with businesses. ESG starts with businesses, but again, we need ESG across all parts of the system. Maybe coming back to you, Alexander, how is the public sector thinking about ESG? Are there learnings you can take from private sector, all of this stuff that we're talking about around data, etc.? Can any of that be implemented in public sector? And how are you kind of thinking about it?
Well, it depends what you mean by sort of public sector. If you mean by the civil service, then yes, there's lots of learnings that we can learn for efficiency, sustainability, but also we've got to realise that the public sector is more able to soak up some of the costs associated with reporting and standards, and actually have a team of people available. When obviously when dealing with businesses, that's going to cut to the bottom line. Now, if you're talking about government itself, which is quite different, I'd say government, unfortunately, doesn't think too much about ESG. I think at the moment, it's not focused on seeing the value and how it adds value to the companies. And I think there is a movement, especially in Parliament, where MPs often talk about sustainability, and talk about trying to do better and help the environment, but they don't actually think about the business implications for that and how that actually can help business to grow. And I think there's quite a disconnect at the moment in the government between people who actually want to drive forward businesses and grow the economy, and those people who actually want to focus more on sustainability. Whereas I think ESG is that confluence of the two, where the two can benefit together. And I still think there's a huge disconnect.
Nina, maybe if I come to you to kind of follow up on that point, how do you think we can kind of square that circle between growth versus sustainability?
Well, I think there are many points there, right? I think one of the points is that effectively we have a field of, we are in the middle of a transition, right? And that transition presents opportunities. We have to fundamentally reshape our economic environment. We have to fundamentally change the way hard-to-abate industries operate. And there is a huge amount of opportunities in transitioning those industries. There's a huge amount of opportunities in the renewable space, in the agri space. So I think, if you're thinking about growth, those two are connected. I think there is a different question when we come to the question about GDP and how we usually measure growth, right? And we haven't spoken about that at all. So if we bring it back to the idea that GDP measures all of our growth, and GDP is very infrastructure-based. It doesn't take into account things like nature, doesn't take into account any of our natural resources. So fundamentally, we also need a different metric to measure the growth, because GDP was introduced in the post-war era when restructuring of infrastructure was really, really important. So I think there are ways to think about this in an additive way. I also don't think it's ever an either-or question. We've run out of time to create this perfect solution in which we all transition in a really nice way. We're going to have to regulate as we're building new technologies. We need a very ambitious but a super stable policy framework that enables our businesses to actually transition, that shows them that this is the way we're going to build an entirely new green economy, and allows them to adequately price the risks and the opportunities of that economy. And in the same way, it's the thing that Eric is doing, the private capital has a unique way to shape the firms that they're working with. Fundamentally and interestingly, probably it's an even quicker channel than public capital does, because you guys are much closer to the organizations that you work with. So again, there are many different actors have very unique points in which they can influence the system transformation. And as we talk about capacity building, and we talk about education, right? Universities have a role to play in educating not only young people, but also educating professionals and building the capacity to enable the entire economy to move here.
Yeah, absolutely.
I know that it's a dirty word, but I believe more in self-regulation than regulation in a way. Not because it's a way to avoid costs or avoid actually working for the greater good, but it's just because there are a number of companies that can't afford it. Yeah. Basically, we invest in companies of all sizes, all shapes across Europe. And believe me, the main difficulty we have today are actually the VC-backed businesses who don't have the resources that they can devote to do what will be required from regulation if it goes in the direction that you're showing. It's important to keep that in mind. I think that proportionality is absolutely key when it comes to regulation, and we need to do it in a way which is appropriate. That's why also we provide a number of tools, from due diligence questionnaires to ESG reporting guidelines, to guide our members in that direction, to help them in their journey towards climate change. Typically, we have free climate change guides for experts, for people that know where they're going, and for beginners, to make sure that they can actually adjust their speed to the level of knowledge and understanding of the topic that they have. So it's really important to not to go too far. And if you're working on the economy and FSDR regulation in the UK, I can only encourage you to be slightly less demanding, because we see the limits of that exercise. And by the way, the EU as well, because actually the SFDR regime will be reviewed in the first years of the next Commission, to adjust it to the reality of what we have seen as professionals and that we have reported regularly to the Commission. I'll stop there.
I know. I would agree with you. Often speaking to organisations, regulation at the moment is so complex and so time-consuming that it's almost not enabling the competitive advantages and the opportunities when it comes to looking at ESG data, climate data, because it's just so incredibly time-consuming. But we're at that, I guess, that education curve where organizations are starting to understand what do we have to report on, what are the benefits, what's the return on investment. So I'm wondering whether also, the public sector, the role of government is education, is that talent deficit that we have, that we can get more talent into these roles to automate some of the regulations so we can go above and beyond and get some of those added benefits of ESG.
Nina.
And if I make just 2 points, and I think, again, it's really interesting because regulation doesn't drive leadership, right? There are companies drive leadership because they believe in the opportunity. Understanding the new environment drives leadership. What regulation does is create an environment where all the laggards are then taken care of, and that it makes it easier for those who are leading. So effectively, those who are leading are supported. They don't have to stick their heads quite as far up above the parapet. I think that's important. And from that perspective, I don't think it's only on universities to build up capacity, right? So if you think about the role of large financial institutions, we did a piece of work with the Banking Environment Initiative where we looked at how large banks can help transition their clients. And that goes for large corporate clients, but that also goes how large banks can work with their SME portfolios. And SME portfolios largely, have very little resources to invest. However, if you're banked by a massive bank who should understand what they're doing in this, they can be using some of that muscle to show the way. Yeah. And having said that, I'm not entirely agree with the let's not go too far on the regulation side, because I don't think we're doing as much as we need to be doing to actually combat the issues that we have. And so from that perspective, we do absolutely need a lot more ambitious regulation coming in.
And I just think, when it comes to regulation...
We will have a discussion later.
There is support.
When it comes to regulation or data gathering, data in itself is actually not that useful. It's what you do with the data that's important. And any regulation that should be there should just be saying, let's just report something, which is great, because we can obviously report anything we want and look at data. It's what are you going to do? We were talking about it is a transition. And if that regulation isn't helping with the transition, and by that I mean actually moving things forward, the regulation is not working. Regulation for regulation's sake is pointless and irrelevant. Regulation that drives change is what it should be measured on. It shouldn't be regulation should never be measured on, are people reporting it enough? Are people ticking all the boxes? Are people sending their reports in time? No, it's not. It's how has the company or the organization moved every year or 2 years or 5 years? And then we look back on it. Has that regulation helped push it forward or has it hindered it? Because the worst thing is companies, organizations spend all their time reporting on all their effort and skills and knowledge-based reporting on data without actually moving it forward. And that is a complete waste of everyone's time. And as we already heard, there's not enough skilled people out there. We're not using them in the correct way. Reporting is irrelevant. Results what matter.
Yeah,
I agree.
Absolutely. I think very interesting conversation here around regulation, not regulation, etc. But I'd like to just open it up to the audience here and see if anyone has any questions for our panelists. You've got a question in the back there. I think we have some mics. It's fine.
Point about regulation or not regulation. You can't talk generically about regulation and say it's good or bad. You've got to be specific because there will be things that are really important for leveling the playing field. Or you can talk generic. If you're talking generically, we're having a kind of a really random conversation. So just wanted to point that out.
Yeah, absolutely. Question from here.
There are lots of free tools out there to help startups and small businesses measure their impacts and also report in line with regulation today. So I'm curious to understand why there's a perception on the panel from some members that it's too difficult and so on. It's not.
Obviously, I run the party group on ESG. We have companies from every single size of companies. It's always a medium one. So they'd rather spend their efforts and time and resource rather than even filling out free forms, actually making money and wanting to grow and scale up. And that is the most important thing for the company, because there's no point reporting if in 5 years' time your company will not exist. And that is the most important thing. So any actual burden on that is actually retarding that growth. And that is a concern.
And if they're not doing sustainability, they will not exist. Therefore, we're back to, I think, to kind of to the original conversation. But I do think there is something about data and climate data and nature data where we apply a double standard. So I started my career in finance on the trading floor, right? If you think about the way financial system work, it's almost an entirely self-created mathematical system, right? And yet for climate and nature, we have a set of standards that are all the way up there. It has to be 99.9% correct for us to move. And arguably, if we take into our stride a little bit more of the uncertainty that we take completely for granted within this normal financial system, we can do a lot more today.
And to answer your question, and actually discuss also your topic, I think that we need to be specific. Let's look at SFDR. SFDR is ruling the way, is regulating the way we are actually reporting on ESG stuff. We've had the benefit of 3 years of SFDR kicking in one way or another. And we have identified a number of known unknowns, as we call them. We actually published a white paper that we distributed to policymakers explaining how the reporting requirements that we have from SFDR or through the taxonomy regulation is actually piling up in a way which makes the understanding of what is required very complicated. And we have no answer, because it's also complicated for the guys who actually wrote the regulation, because they did not take into account what was already existing in terms of requirements that we have to actually follow. As a result, as I mentioned earlier, the SFDR regulation will be reviewed in depth, and we hope that we won't have an SFDR 2, an SFDR 3, an SFDR 4 going forward. We ask policymakers, guys, just do it well next time, but for good. We don't want to have, again, another headache, because it translates into cost, stress from portfolio companies, CSO and managers, because they don't actually know whether they have reported correctly or not to a specific requirement. Well, that's why, irrespective of tools, methodologies, and free or not free tools with which we can equip our portfolio companies, there still are issues that needs to be solved.
There are over 70 different sustainability frameworks out there. So just the severe complexity, as you say, are we complying with X framework? Are we complying with Y? Is actually more time consuming. I'm in absolute agreement that regulation is driving. It's just how do we make it as simple as possible to enable the ESG teams to then look at the competitive advantages of then taking it above and beyond some of the tick box, we've got to comply with X framework.
And so that it can't be gamed as well, because if you have 70 different regulations, you go for the minimum required standard, and then you look where you go. You look where you IPO, depending on what kind of exchange regulation you have in particular jurisdictions.
Correct.
And that is the big issue with all of this. If people do game the system, I think a lot of companies do game it, it undermines the credibility and confidence in, frankly, sustainability as a whole. And we know that the majority of the public do support sustainability, but not everyone. And actually, when you look at it, when it comes to cost and stuff, some of that support is only wafer thin. And if you start putting companies putting dodgy frameworks, or they're not actually sustainable, and that's revealed, it's going to be a huge exposure, and will actually damage credibility of what hopefully we're all trying to do and achieve here.
Yeah.
And on top of the disclosures, you're getting a lot of our customers are getting a lot of requests from whether it's tenants, suppliers, buyers, investors for more transparency. So bespoke reporting on top of the mandated TCFD, ISSB, EU taxonomy. So it's a lot of reporting versus actually action. And I think we're all in agreement that we want to move towards the action.
Yeah. We've got a question up front. Yes.
Thank you. I would have a question to Eric about the ESG due diligence checklist or guideline that you have.
Yeah.
I think it's a brilliant document, and I think, well, I should probably say that I have tried to find somebody who actually uses the full extent of it in due diligence. So I'm curious, would you have insights or experience or examples whether somebody actually uses at its full extent, and is it dependent on deal size or something else?
No, I think it's really a question of the practice of each investment firm. Depending on how they're advanced on this journey, they use it in a more complete or less complete way. Basically, that's the thing. I need to say that this tool has been built between LPs and GPs within Invest Europe, and that it's a member-only tool that we don't provide for the public. That said, this tool has been recently updated to take in the latest important things that we need to take into account, human rights being one of them. So it goes quite far. It's quite advanced, but it actually really, and that's why I'm a great fan of self-regulation. But I like regulation to a certain extent. Let's be clear, and we're proud of what we have in Europe when we look at what exists in the US. Again, to be very clear. But on this one, it's really a question of how advanced you are and what are the level of granularity in which you want to go. And it echoes also the value creation topic that Nina mentioned earlier. The more we look at data, and it's very complicated and increasingly complicated, the better we measure what we have done, and we can explain the value creation journey to the next buyer that will buy the company that we have in our investors on. But it's true, I would be very happy if everybody was following the due deal from A to Z, but that would not be true.
Wonderful. I think we have time for one final question. We've got one there, yeah. Thank you.
Thank you. I just wanted to pick up on a comment you just made, Nina, about the high standards that we apply to climate and nature data, and actually we need to take on more uncertainty, but that creates direct conflict with new regulation coming in that's requiring it to be audited. And if I link this panel back to an earlier panel about CSOs working with CFOs, the CFOs are saying, well, this is not auditable data, and therefore they're kind of paralysed with, I don't want to expose myself, the auditors are going to, and there's also increasing fees from them, so going back to regulation being highly costly. So they're not able to exploit competitive advantage on ESG because they're stifled by needing certainty in data because of the audit requirements from regulation. So just wanted to maybe dig into your comment a little bit more about accepting more uncertainty.
So if I make three connected points in, right? So if you go back in time to when the Black-Scholes pricing model was introduced in financial markets, it's a derivatives pricing model, right? At the moment of its introduction, it didn't mirror the market very well. Within a couple of months, it mirrored the market almost perfectly. Does that tell me that the model got better? No. It told me that more people started using that model and the market adapted. And the part of the point that I'm making is that if we change the economic models that we are basing a lot of our valuations on to embed the externalities that are currently sitting over there, and that's the destroying of our nature, of our ecosystem services, of climate on which we fundamentally depend, if we actually bring that in, suddenly our accounting starts being very, very different. So that's point number one. Point number two, we absolutely need to upskill our accounting professions because they all have wonderful consulting bits. The Big Four have absolutely fantastic sustainability practices that do brilliant jobs. If you survey their audit practices, that's a slightly different matter, right? So they need to be able to audit all of that data that goes into the financial statements that shows environmental impact, environmental performance. That's point number two. Now, point number three is, and I think all of us thinking that the TCFD, TNFD, and then the incoming TI and TSFD, right, when that gets built, what we're going to end up with is one set of financial disclosures that actually look at both the risk side and the impact side of the equation. But what is currently happening, and I've had this conversation in really interesting ways, right, is somebody wants to publish a sustainability report, their CFO is not letting it out, so they publish it under their CSO in a different part of the page, which is not really helpful to anybody because you take it out of the mainstream financial disclosures. So I think where all of us are going towards is one set of financial disclosures that works on slightly different incorporation of the things that we actually depend on to make companies and our lives work.
Thank you. Unfortunately, we are at time. I just wanted to end by going back to the question we started with, which was, does ESG create competitive advantage? And I think we're all aligned here that it very clearly does create a competitive advantage. The question is how? How do we leverage it and how do we enable it? What are all of those factors in that ecosystem that enable it? I'd just like to end by asking everyone to just thank our panelists for all of their perspectives.